If you have ever heard someone say it's investing in the stock market and you thought to yourself, is that safe? Then this video is for you. And you think about the possibility in investing in diverse stocks or in diverse companies at the same time, you might want to listen to this video. Welcome to another day of our money mastery class. In this lesson, we'll be looking at two major topics, looking at the bond and the stock market. Then we'll be looking at the mutual funds and ETF, that is exchange traded funds. When we talk about stocks, how do we mean? Stocks is like having a slice of a company. Stocks relates to ownership. That is, you own a portion or a slice of that company. So if that company grows, your investment grows, or there's a loss in the value of that company, so also the way your stocks lost value. Now, let's look at bonds. Bonds is like lending out money. So if you bought into the bond issue of any company, it means that you gave your money to that company to use. And the time you lend that money to them, for that time, they are going to pay you what we call interest. So bonds relates to like lending out, lending your money to a company. So it could be a government, it could be a company. The difference between stocks and bond is this. Stocks is volatile. That is, stocks move up and down the ladder, right? It's never stable. Just like what's going on around the world, talking about the market going down, people losing money. That's what it is. It's never stable. There might be a time that it's going to come down. There might be a time that it's going to increase. Then people make money from the stock market. Exactly, that is what it is. So it's never a stable market. And you can have high return in the stock market compared to bond market. In bond market, it's very stable, but the return is lower. It's stable, but the return is lower. Just imagine giving someone your money to use for a fixed interest, for a fixed percentage interest, is a stable investment. Okay, so that is the difference between investing in stocks and investing in bonds market. Now, what are the risks there? The risk there is one of those things I've mentioned during the explanation. The risk there is that in the time of crash, when the market goes down, you lose money. That's one of the disadvantages of investing in stock market. But it could also go up tremendously, that you gain a whole lot, when investing in stocks. But bonds are more consistent and ideal for preserving wealth. So if you want to preserve wealth and you want just your money to earn something, just earning the minimum, right? Of course, there's this saying, the higher the return, the higher the risk. Bond market is less of a risk. Also, the return is very low most times. Investing in stock market as an investor could be very good for young people, or who are not getting closer to their retirement age yet, who can still make a whole lot from the stock market. They can invest in stock market. But for those who are nearing or getting closer to their retirement age, you want to preserve your wealth, you want to preserve the money you have yet, you might consider investing in bonds, in the bond market, rather than investing in stock market. Because stock market, like I said, it could go up and it could come down. It might be the time, as someone who is getting close to retirement and the stock market start coming down, you might lose money in that regard. Investing in stock market is a long-term thing. You have to be sure of what your investment goal is. Are you going to invest in the long term? And that's going to determine if you are going to invest in the stock market and at what age bracket. Like I said, for young people, investing in stock market is very good because over time, it's going to make them build up a good wealth. Having the right mix of the two markets is very good. Either you want to combine, a certain percentage of stocks and a certain percentage of bond. When you allocate a certain percentage of your money to be invested in stocks and a certain percentage of money to be invested in bonds, you're having a good mix of them. In that regard, you are sharing the risk. you are not too exposed, that is, your exposure to risk is not too high, it becomes moderate, or what we call can become balanced, so that your reward also over time can be a mix of it, moderate. So you can let us know what is your investment strategy. Either you are investing in stocks only, or you're investing in bond, or you have a mix of that. Let's hear you how you manage your investment portfolio. Then the question, how can you invest in the stock market and have the opportunity to invest in different companies at the same time without having to be choosing which companies or what companies you're going to put together in your portfolio? And that answer is in what we call the ETFs, which is exchange traded funds, and mutual funds. These are diversification simplified. Diversification simplified means that if you are investing in so many stocks at the same time, which will incorporate many industry or many markets or many economy, right? So the only way to do that without much of a stress of trying to simulate or permutate which companies, in which country you are going to, there are already developed funds that can help in doing that, which is your exchange traded funds and your mutual funds. So let's look at these two different funds. What are the differences and what are the similarities, and which one might be best for you? When you think of the ETF, that is exchange traded funds, think of it as a basket of stocks you can buy on the stock market. What do I mean? In that fund, exchange traded fund, you can have different companies from different economy or different countries in one purchase, in just one investment. So that's what we call exchange traded funds. It's like a basket of stocks, right? The cost of investing in this most times is very low, and it could be very flexible. It doesn't tie you down. It's flexible. You can invest in it, you can take the money away and invest something else, and you can break that investment, for whatever you want to use the fund for, right? And it's also great for beginners, those who don't have much experience in the stock market, whereby just locate a very good fund and invest in one of the available exchange traded funds, right? And when you talk about mutual fund is also a basket of investment. But the difference between ETF and mutual fund is that your mutual fund is professionally managed. Take it as a basket of investment which are professionally managed compared to exchange traded funds. Exchange traded funds need not be professionally managed, and it could come with high cost for you to invest in mutual funds. These mutual funds, they are good for those who don't want to manage their funds by themselves, in the sense that you want someone to manage that fund for you. You want some selected professionals to be able to manage the funds on your behalf. This is very good, which, of course, because you don't want to manage it yourself, so you need to pay for the services of those who are professionals. Let's do a further breakdown. Buying an ETF, that is exchange traded funds, is like grabbing a pre-made fruit basket off the shelf. It's already mixed. You just go there and say, this fund is what I want to invest in. So you already know the composition of that particular fund, the ETF. You already know what is made up in that basket you are buying into, and the price is just as right for you based on your how much you want to invest and your investment goals, right? But when we talk about mutual fund, a mutual fund is more like a custom order. So it's tailored to your investment need or your investment goal, right? So you get quality service. That's why you have to pay for it, because so it takes an extra fee for you to get that custom made investment bucket for you. So it is selected and delivered to you at the end of the day. So which is best for you? If you are just starting up and you don't have much experience in the market, you could just look for some index fund, and invest in. There are so many of them, and which are low cost. You can research, or you can talk to your investment advisors that, okay, you're just coming into the stock market, which will be the best fund you can invest in. there are some pretty low cost index exchange traded funds that are available that you can invest in. So you can let us know which of those ETFs or mutual funds you have invested in. Let's know, comment in the comment section, and let someone benefit from your investment expertise. So everyone, thank you for taking the time to follow us, to subscribe to our channel, to share, and to like, and also to comment. We really appreciate your feedback. See you in the next video. Thank you.